The implications for this are just so broad, because everybody owns ETF, from the lowliest retail investor who just has a couple of $1,000 in the stock market. I guarantee it's in an ETF unless he's inherited shares from.
This is now the mode of investing.
But up to active managers who now, I mean, everybody is in these things.
Not everybody, but you are correct that what's happened is that there are secondary effects that happen over time, and then tertiary effects, and reality changes. So the ranks of analysts, equity analysts, has thinned tremendously in recent years. I don't have a way of quantifying it, but I know that they have, because either when their employers, a large brokerage firm or investment bank or mutual fund company, begins to change its business focus to provide index products, they no longer need security analysts. So security analysts either leave the business or they convert and become ETF analysts.
Yes.
Right? Then you have managers, they're active managers who have been necessary participants in the outflows, which I'll talk about, from active management, and they're just losing business because they're not able to demonstrate their competence versus the indexes. We'll talk about that. And sometimes you just go with the flow. So they've adopted index-based investing, modeling, robo-advisors. You can get it for free now from a robo-advisor. So not all of them have given up. You'll have people, active managers of note, renowned, regaled, people like Mario Gabelli, who won't change what they do. They're not going to fold, and they lose money every quarter, every month, and they're putting up with it. They're holding their ground.
Well, this is, I mean, you said, I think when you were talking to Jesse, you made a great point. You said, what are the statistical odds that all these household name managers all got stupid at the same time?
Well, so yeah, we keep a list. And it's not a complete list. Actually, when I mention it to somebody, they'll give me another name or two, which I haven't, you know, people I wasn't thinking of. But when people, sometimes a picture's worth 1,000 words, so this is a list. So I made up a small list of managers, some of whom, like the fellow at Fairholme, Bruce Berkowitz, he was named Manager of the Decade only a few years ago, right? So you got Fairholme Fund, you have Gabelli Value Fund, you have David Wintergreen Funds, Longleaf Partners, Pershing Square Holdings, Icon Enterprises, Carl Icahn, Greenlight Reinsurance with
David Einhorn.
David Einhorn.
Einhorn, yeah.
You got Royce, Chuck Royce.
Yep.
Anyhow, in 2014 and 2015, and then now in 2016, you have some of these managers with 2 years back-to-back underperformance relative to the S&P 500 of 10 to 20 percentage points a year.
Yeah.
All of them.
Yeah.
And they're not just numbers. Context is really important. None of these managers does the same thing. If you were to line up all their portfolios next to each other, there's very little overlap.
Yeah.
They have different interests, different skill sets, different techniques. They're doing very different disciplines. And how is it possible that many securities with people who've demonstrated their skills over market cycles, and I said, suddenly all got stupid together. They all lost their touch. The odds, probabilistically, I think, are very slim. So it begs a question, is it them or is it the market? Now it sounds bizarre, or certainly a trumpet note of hubris, to say maybe the market's wrong.
Right.
And it sounds that way until it happens.
But but instinctively, I get that impression that people think that's it. This is not right. You hear that all the time when you talk to people about this stuff. This is not right.
Yeah. So they don't have the language, and they don't have the knowledge of the history to figure it out. And that's what this talk was about. So if I take you through some of the steps, there are two trends that crossed paths around about 2007, okay, at a juncture. So the two trends were, one was the decline in interest rates, right, which has been happening since 1981, when 10-year treasuries were about 15%. And then in the wake of the financial crisis, they were driven down even further, towards zero. And, okay, that was necessary. People should understand that interest rates this low and this sustained, and worldwide, has never happened before, not in 5,000 years of recorded financial history. Understand that I know you had a bit of this discussion with Jim Grant, and he was giving you specifics, that interest rates might have touched this level for a period of time, and in some cases longer, right? But still, it wasn't to this degree. We have sovereign debt, trillions of dollars of sovereign debt in the world. You know, Germany, for instance, German bunds, that have negative nominal yields. Okay? There was secured lending and a history of interest rates. There are a number of books from authors who spent decades of their lives collecting this data from all around the world, going by 5,000 years of interest rates. It's never been lower. And that should give anybody pause, meaning it's a special time. No one wants to be a footnote at an inflection point in history, right? There's something different now. Therefore, you should pay attention.
Yeah.
Inflection points are important. So you have that. At the same time, you had the slow increase in usage of ETFs, which are a relatively new tool that had to be approved, which is basically a mutual fund, except instead of buying at the NAV at the end of the day, what it's worth at the end of the day, and they issue you new units, open-ended mutual funds. These could be bought, and these could be traded every minute of the day, and the prices of the securities inside are priced every minute of the day, every second, every few seconds really, so that it's now tradable. People like that. And it could be cheaper, and it's more liquid. So it was being used more and more, but not a lot. But then came these two, the decline in interest rates and the availability and slow growth of ETFs. Those ETFs were now available at the juncture of the financial crisis. So you have the financial crisis, and every market participant, not to be florid about it, but it's true, in a vertically integrated fashion, was traumatized to some degree.
Yeah. From
the retail investor to the retail broker to the higher end financial advisor at a large firm to the consultants who evaluate managers to pension fund trustees. And at that moment in time, they wanted away from risk and away from volatility. They wanted away from security-specific volatility, from manager volatility, from sector volatility. At first, they just went to cash, which was not the retrospect the right thing to do.
We're back to that scar tissue thing that we
yes,
were talking about earlier
exactly.
on. Yeah.
And then when they wanted to venture out again, after the market was up, which always happens, an ETF served the purpose. So in its most simplistic use or utility, if I pick my favorite REIT, maybe that's when it goes to zero. Even Simon Property Group, which is, let's call it the class act in the group, fell 70%.
Yep.
So at least if I buy my favorite REIT ETF, whether it does well or not, I know it's not going to zero.
Yeah.
And if I'm a manager or if I'm a pension fund trustee or an advisor of some sort, that's helpful to me. Okay. So what happened is money began coming out, I should say pouring out of equities in the United States of America on a net basis. And certainly every single year, bar none, from December 31st, 2006 through December 31st, 2016, money came pouring out of actively managed equity mutual funds. At the same time, without an exception, money began pouring into, year by year, without exception, index funds, ETFs and index mutual funds. And if you add the two up, they both add up to about $1.4 trillion. $1.4 trillion out of Mario Gabelli and David Einhorn funds, and $1.4 trillion into index funds and ETFs. That's a lot of asset allocation going on.
Yeah.
That's a lot of supply and demand. So two things are happening. So it's not just that Mario Gabelli, I just use him because he's fun to use. And it's not just that the stocks he owns, people aren't interested in and aren't doing so well. He's also a forced seller.
Yeah.
So there's a downdraft on those. And meanwhile, the money's flowing in to index funds. Okay. And that's an automatic inflow. Now, to get to the nitty-gritty of it, some people like the ExxonMobil example.
Yeah,
and I chose it because everybody can relate to it.
Yeah, exactly.
So ExxonMobil, give or take, is usually one of the largest companies in the S&P 500. People know what it is. First, I have to explain, though, the business of indexation a little bit. So you have to understand someone else's business model. Now, like I say, I'm in the 1% business. Typical investment advisor, someone brings me an individual account if that's what I'm doing, or you have a mutual fund, and you have the 1% fee, let's say. And I met a woman a few weeks ago. We had a nice long discussion, and she has her own investment advisory business, and she charges a 1% fee, and she has $100 million of assets under management. And between her and her assistant and her research assistant, they make a nice living. That's the 1% business. The ETF business is a basis point business, meaning fraction of 1% business. So, for instance, the S&P 500 today, as an ETF, BlackRock or Schwab or Vanguard, could be as low as 4 or 5 basis points. If you collect $100 million or $300 million or $400 million for a fund like that, you're not making money.
No, right.
So the key for the indexation business is being a low-fee business. It has to be done in scale. And to do it in scale, you need, particularly when you're dealing with hundreds of billions of dollars, trillions of dollars, you need to use companies that have sufficient trading liquidity. I say liquidity, I'm not talking about the balance sheet, I'm talking about the share trading.
Yeah.
And the reason why is that you don't want to be constrained in your scalability by, within your roster of securities in your ETF, whatever it is, a REIT ETF or something else. You don't want to be constrained in your ability to get more money, manage more assets, by the least liquid members. So let's say halfway down your roster of names, going from the largest to the smallest in terms of weighting, halfway down is a company that has got 40% inside ownership. And so there's really not that much trading volume, and yet it's a fairly significant position. Yeah. You can't go any higher. You can't make it from a 1% position. You can't make it higher. You're not allowed to. Or down at the bottom few stocks are just not trading enough, and you can't scale up. So what do you do if you're a rational business person? You figure out a way to reduce them. Okay? So Standard & Poor's started this process of adjusting the rule set to accommodate liquidity needs in 2005. And until that time, my understanding of the Standard & Poor's business was, it was a pretty good business. They collected fees for information about the index and the sub-indexes. So if you go to your Bloomberg and it gives you all the information you want about the S&P constituents and the returns and so forth and so on, you're paying Bloomberg, and Bloomberg pays S&P. Yeah. They also collected some basis points in the nice business. If some mutual fund invested according to the S&P 500 model or compared themselves to the model or whatnot, they got paid basis points on that $1 billion. But they wanted more. They wanted to be in the asset management business. They wanted to create an ETF, S&P 500 ETF, and they began to think about this problem of scalability. So they went to what's called a float-adjusted mechanism, meaning that if Microsoft and let's say Walmart had roughly 40% inside ownership, which they did, they would adjust their weightings in the index downward to account for that. It has a certain logic. So Microsoft was not 4%. I'm just using because the numbers are easy. If Microsoft was a 4% position, and they adjust it downward for the 40% inside ownership that's not available to trade, it would become a 2.5 or 2.6% position. That's how it worked. So you see how, therefore, the business model, the incentive system, begins to affect the rule set.
Well, and it's actually the inverse incentive system to the one that's in the best interests of the stakeholders, essentially.
Yes. So what'll happen is, so let's say Bill Gates, let's take the same company and take two events which might or might not have happened, or whenever they did happen. Let's say Microsoft decided that its stock was so cheap, and I don't think they did this, but let's say they did, so cheap they decided to embark upon a massive share buyback program. For some reason, people didn't like it at a certain point. It's a PE of 10. They know what they've got. And they buy back 20% of their shares. In the way that the indexation system works, the market cap weighting system, is Microsoft would now have 20% fewer shares, 20% lower market cap, and it would be given a reduced weight in the index, meaning the index, reducing it, meaning all the managers, including active managers who kind of hug the index, would have to be sellers.
Sure.
And index funds and ETFs would have to be sellers automatically, even as Microsoft is buying. On the other hand, if Bill Gates retires, as he did, and he decides to start lightening up and selling shares, so his shares now come into the float, they're now available to trade, and therefore the market cap of Microsoft expands, the float expands, and they're going to raise the weighting, meaning managers are forced, and indexes must, buy the shares even as he's getting out.
Yeah.
Isn't that interesting?
Yeah.
Okay.
And this is Bill Gates being a good guy retiring. This isn't some director knowing that there's a fraud in the balance sheet.
That's right, because there are other companies in which somebody is distancing themselves for an economic business reason.
Yeah.
Okay, so there's that. Now, what you'll find is that there really are not that many companies that are liquid enough, large enough and liquid enough in terms of their trading capacity to suit these needs. I'll call it industrial scale investing. There are not that many of them, a couple hundred. And if you go overseas, there are even fewer.
Yeah.
And therefore, all the different ETFs, and we'll go through some of them, momentum ETFs, value ETFs, growth ETFs, which are all subsets of the S&P 500 or the Russell 1000 or Russell 2000, they keep trafficking in the same securities over and over and over again, whatever they call it. So I'll give you an example. The Central Bank of Switzerland, the central bank, buys US stocks. When you talk about price discovery and a free market, it's important.
Yeah.
It's important that prices be developed freely between buyer and seller. There's natural tension. But now, if you have a central bank with essentially unlimited funds buying stocks, buying U.S. stocks, and in what fashion are they buying them? Are they buying them with an evaluation of their future value or present value or price? Is there something else at work? So for some reason, and we don't know why, the Swiss central bank has been buying U.S. stocks, and they have a portfolio of it, and they buy every month. And it's so large now, the market value of the holdings. So in the middle of 2015, it was like $39 billion worth of stocks. And as of the end of 2016, it was $63 billion worth of stocks. It would be one of the largest ETFs in the country if it were an ETF. Now, the way they buy it, they have 2,564 positions as of year end. That's a lot. Very diversified, right?
Yeah.
But the top 10% of it, by weight, is in only 250 names, 256 names. And as a share of the portfolio, those top 10% of the names account for 75% of it. And the average market cap of those is basically $60 billion. It's just an algorithm. They have a robo-advisor set up that buys stocks all the time, like the S&P 500 essentially, or the Russell 3000, but it's limited by the liquidity. They can only buy that much with the top names. And to show you how much value and price is completely irrelevant, we showed that they're actually buying Israeli stocks too. They don't know they're buying Israeli stocks. Someone set up the program, apparently, I'm inferring, to buy on the basis of the CUSIP numbers.
Okay.
CUSIP number is this identifying number for every single security. And they're going that way. Now, there are companies, Israeli companies, there are dozens of them that are in here, that trade in the United States, but the programmers for the Swiss bank didn't know that if the CUSIP is preceded by a letter, it's a foreign company. Yeah. So they're buying those too. That's how blind it is. So now, with that as an introduction, you'll see that money is flowing in every day. There's an automatic bid, as we'll call it, for any stock that's a major holding in a major ETF or index. It automatically gets bought. And that's valuation indifferent. It's got nothing to do with valuation. There is no factor in the decision-making process for valuation. Okay, it's just based on exposure. So the ExxonMobil example, to start with an easy one, was that, and I used the conceit that if you were sitting in a train station, here in New York City, be Grand Central Station, waiting for a train, and you saw someone had left a tear sheet from an annual report, a page from the annual report on ExxonMobil, and you looked at it, and you saw something strange. What was strange about it was that it had been left by a time traveler from 2016. And so there you have before you everything you want to know about the balance sheet and income statement of ExxonMobil several years into the future. So I think I chose a 3-year period from 2013 to 2016. Okay? So here are the facts that you could avail yourself of from this tear sheet from 2016. So we know oil prices went down. That's not in there. It's not in the tear sheet. So we know that the revenue went down 45%. So ExxonMobil had just a touch under $100 billion of revenue in 2013, and it was $54 billion in 2016. We know that the earnings per share went down 74%.
Right.
We know that the dividend payout ratio ballooned from a third to 160%. Okay? It quadrupled. The book value per share was up 1% or 2%. And the debt almost doubled. Not a problem, not an existential problem, but the debt almost doubled. Okay. So I don't know about you, but with that special knowledge nobody else had, I would short the stock.
Yeah.
And I would have lost money because the share price has gone up. And you wonder, how can that be? Well, maybe people saw through the cyclicality. But if you look at other oil sector companies, that's not what happened. Their stocks went down a lot.
Yeah.
Okay? So the question is why? And the reason is that ExxonMobil is about the most liquid trading security you can possibly find and about the largest market cap. And therefore, if you're an ETF provider and you need to build a new ETF, attract money, and I'll tell you why they're so desperate to do it in a moment, you're going to use ExxonMobil. Yeah. You need to use
it. Find a way to shoehorn it into your index somehow.
You'll find that ExxonMobil will be in, I'll read them to you. ExxonMobil is in the iShares Core High Dividend ETF, has high dividend yield. It's in the Russell 1000 Value ETF, it's a value stock. It's in the PowerShares 500 Buy Right ETF, where they buy and write options, I guess. Yep. It's a low beta stock. It's in the low beta income ETF, the First Trust low beta income ETF. It's in the Spider S&P 500, S&P 1500 Momentum Tilt ETF.
It's momentum stock too, good.
It's in, basically you'll find it everywhere. It's a growth stock.
I was just saying, it's
right.
Okay, it's a growth stock too.
Yeah.
Fantastic.
So it's everything. And it needs to be everything because it's necessary raw material in industrial scale investing. Now, here's why it's everywhere. If I'm in the business of being an ETF provider, when I started back in, let's say, 2007, I saw the opportunity. We had a lot of ETF providers that become more concentrated, but your BlackRock or your Vanguard, your State Street, your Schwab, it was all set to be a fairly comfortable oligopoly. So you charge your 50 basis points, it's a lot cheaper than a mutual fund, and it's more liquid, easy. It could have been that way, except for a confounding factor of Vanguard, because Vanguard is a non-for-profit institution, and every time they expand and get more assets under management and the unit costs go down, they lower their fees a bit. Mm-hmm. So Vanguard began to lower its fees, and so on the plain vanilla funds, the easiest ones like the S&P 500, the Russell 1000, and the Russell 3000 or 2000, the fees went down and down and down. So they've gotten fees down, as I said, to like 4 or 5 basis points. Yep. Now they can't make money at 4 or 5 basis points, but they're not intending to. But neither can BlackRock. Now BlackRock is a rational player. We understand how they think. How are they being rational? Well, one way to make money, therefore, is to differentiate your product. And they've been differentiating products people have been doing for years, right? You've got, how do you differentiate shampoo, right? Or vodka, right? That's how it's done. So they would come up with a slightly different exposure. So you'll have S&P 500 value. Start easy, or S&P 500 growth. When you issue a new ETF, the business of it is, first of all, it has to backtest well. You have to have your 5-year backtest or 10-year backtest and show that these holdings did pretty well. You have to have a beta volatility, people don't want volatility below 1, less than the market. And they will figure out a way to have a rule set that encompasses stocks that have these characteristics. And then when they issue the ETF, it'll start usually with 50 basis point fee. And over time, you'll see, as the older they get, and Vanguard gets involved, the fees go down to 30 and 20 and so forth. That's why you have this proliferation of ETFs. The essential concept of indexation, as created by the founding fathers of indexation, the intellectual and academic founding fathers of indexation, Paul Samuelson and Fisher Black and even Jack Bogle, was you just want exposure to the entire market, to the asset class. Yeah. The notion of subdividing it runs counter to that. Now you're picking and choosing. Okay? But so now indexation, with all this proliferation of subsets and ETFs as the business end of indexation, they use the terminology of it, but they're really not doing that. So you can see why they'll need an ExxonMobil. Sure. They need it. Now, as a further proof, too many people might know of ExxonMobil. They might insist that somehow it's a factor of its cyclicality, people looking through the cycle. I can do this next exercise with almost any of the major blue chip traditional companies in the S&P 500, whether it's McDonald's or Procter & Gamble or Colgate or Pepsi or whatnot. A few statistics on McDonald's. 2008 versus 2016 is a good period for them because we're starting from the bottom of the market. There was a deep recession. So revenue between 2008 and 2016 was up in total for all those years, 4.7%, which is less than 1% a year. Mm-hmm. Net income in total over 8 years was up 8.8%, which 1%. Is 1% a year. Long-term debt up 154%. Equity went from positive to negative. It's now negative because they've been buying back a lot of shares. Yep. So the only thing that moved up a lot on McDonald's balance sheet is the debt. And the only thing that moved up a lot in its market profile is its share price, which is up 95%, and its PE ratio, which went from 17 to 22, it's up 30%. Okay? So explain that to me. I'll explain it. Years ago, before the rise of ETFs as the mode of investing, people might have bought, let's say, Walmart. When I left Bankers Trust Company at the end of 1994, I'd been asked to approve adding Walmart to our list of stocks to buy. Because I was on the committee that does that. And I kept asking the analyst who was prompted to propose it questions that apparently I wasn't supposed to ask. It was impolitic of me. The reason the head of the unit asked the analyst to, why don't you take a look? Take a look at Walmart, and why don't you make a presentation to us in a couple of weeks, whenever you're ready.
There's an implied statement.
Because we didn't own it, and had done very, very well, and it was an embarrassment. Yeah. So make it an option to buy. So, okay. So he's talking about how wonderful it is, how fast it's growing. And I said, yes, it's a wonderful company. It's growing very fast. It's growing 30% a year in terms of earnings. I said, but it has a PE of 30. I said, don't you think it's a problem? He said, no, but they can continue expanding. I said, can they expand to 30%, like for a long time? He said, they're doing so many things. They have tricks. They can take the back of these huge stores, and they have more land, and they extend the back 20%. Very little cost, right? More throughput and so forth. I said, yes, but still, there is a law of large numbers. If they're as large as they are and they're growing 30% a year, and I forget how many years I calculated, but not so many years.
It's not many.
They would account for 100% of all the retail sales in the United States. So I said, at some point, it's going to slow, right? Yeah, it'll slow. I said, yeah, but if it slows from 30% a year to 25% a year, don't you think the PE will contract? People will be disappointed. The PE will contract to 25? He said, yeah, but it's still good. I said, but you can do this for years. It's like going up and down an escalator. Anyway, the older, more experienced, seasoned portfolio manager next to me, there are different ways to be seasoned. He's going to elbowing me. Anyway, what happened is, it never collapsed. But it was almost a decade. It went nowhere.
Yeah.
And even as earnings were positive and rapid but slowing, until it was finally PE of 12, which was where it ought to be. So people voted with their feet. They bought Walmart, and little by little they decided not to own Walmart. But today with McDonald's,
I'll do it.
Nobody really has bought McDonald's lately individually. They bought it as part of a basket. They're not even thinking about whether they're satisfied with it or not. But if they're just satisfied with McDonald's, they can't sell it individually. They can only sell the basket.
Yeah.
Which begins to show you now how the money flowing into the ETFs, in which ExxonMobil is a large constituent, or McDonald's is a large constituent, these stocks get an automatic bid.
Yeah, it's not coming out again.
They're being bought on the margin, irrespective of their growth pattern or their valuation. We're not having price discovery anymore. And if you don't have price discovery, how do you know what you really own? Go back to the iShares Emerging Markets Bond ETF, high yield bond ETF. What do you really own? What's it really worth? You don't know anymore because the price discovery mechanism, of which active managers, with all of their faults as well, the natural dynamic tension between them, trying to figure out what a good price is. Not that they weren't subject to the very same ills and bad thinking that indexation is, but that's broken down. So what happens now in the S&P 500, for instance, is that the largest companies in there, Coca-Cola, has had sales declines for years now. McDonald's has no sales growth. Procter & Gamble has no sales growth. It's simply a function of generations of their expansion, law of large numbers. Now they have saturated their markets.
Yep.
And there's only so much more per capita of diapers or cigarettes or alcohol they can sell. It's a limitation. There's nothing wrong with it. There's just, you don't pay 25 times earnings for it.
Right, exactly
you pay 12 times. So those companies are being kind of affixed near the top of the S&P 500. They are crowding out smaller companies that might be growth companies that can't get up. But their growth is slow now. That's one aspect of the S&P 500. The other aspect are companies that are really growing fast, like the FANG stocks we talked about, the Facebook and Amazon and so forth. And they're priced at white-hot bubble kinds of valuations, where there actually is growth. And they have their own problem. But that's what you have now. So the challenge is to think that the statistical history of the stock market suggests that stocks will generate 10%, 9%, 10%, 11% annualized returns ad nauseum. Reversion to the mean, there's a basic economics behind it, GDP growth and so forth and so on. And we think that we're in a special time now. It's not going to happen. And without belaboring too much the various reasons why, there are a few observations you can make. First of all, the notion that, statistically speaking, there's a powerful argument over almost 100 years, from the Ibbotson-Sinkfield study, starting in 1924 onward, that stocks tend to give you 10% over time. Mm-hmm. Just hold on to them. First of all, does it really make sense? It doesn't matter what price you pay?
Well, exactly right. It's your entry point. Of course it always is.
It does, and there are lots of nice charts one can make about that. It does matter. But I'll make it even simpler than that. I'll say, I'll accept it. I don't, but arguendo, I'll accept that 100 years of statistics is just a powerful, powerful argument for a certain return. You say 10% a year. I'm sorry I'm making it you, but you're sitting in front of me.
That's fine.
I'll say, I accept it. But now I'll say, ask the question, which 100 years?
Yeah.
Because now there's another 100 years. So that Ibbotson and Sinkfeld study, which modern portfolio management, asset allocation theory, the pie charts and all that, they really couldn't have developed without that study that was developed in the 1970s, where they went back and got the monthly returns and prices for large cap stocks and small cap stocks and treasury bills and treasury bonds and corporate bonds and inflation right? And gave you all this raw data by which to develop all these correlation statistics and return statistics. They made it possible. That's what feeds into all of these pie charts and planning models. Okay. Now, this year, the 2017 edition, for the first time, is published only a few months ago. They did the prior 100 years. And that was only made possible by advances in technology and software, where they could, some people might argue with exactly how valid is it, but they could go through any kind of source now, and you have optical recognition software, journals, books, magazines, and so forth, and collate it and treat it and so forth. And it turns out that the prior century didn't look
quite so good.
Quite so good. It looked very different, in fact. So it might interest you to know that for the prior 100 years, we'll start with this, from 1824 to 1924, the annualized return from stocks, and this doesn't sound terrible, was 7.3% a year. Okay? But only 1.1% of it was from appreciation. The rest was from dividends.
Okay.
Okay? So if we were to have a repeat of that, 1.1% a year, going forward for the next 100 years, but we're only starting with a 2% dividend yield, that is going to throw a monkey wrench into a lot of pension plan and retirement assumptions.
Essentially all of them that are already in existence.
Yeah. Essentially all of them. But if you take it for 100 years, 117 years, we extend it from 1824 to 1941, the annualized appreciation was only 0.8% a year. And let's take two 50-plus year periods where it's even more stark. From 1824 to 1876, and this was obviously affected by the post-Civil War Reconstruction costs, the annualized rate of return, including dividends, was 0.06%, meaning zero. Right. Take another 55-year period, 1865 to 1920, from the end of the Civil War to the emergence of the United States as a great power. The annualized return was 0.48% a year. And there are other numbers, you can look and play with these numbers, but the point is that there certainly is precedent for generation or more of really very poor returns.